So today we'll be talking about important stuff, very, very important stuff when it comes to audit. Talking about the fundamental principles. We're talking about independence, confidentiality, and conflict of interest. You know, these are very, very important things that you need to understand when it comes to your audit exam, So it's very, very key. It's very, very key. Please get it right. Please understand this. It's one of the critical portions of audit. Independence and confidentiality and conflict of interest. Very, very important. Okay. So let's delve into fundamental principles. You know, the audit and accounting profession has rules of conduct. You know, it has certain governing guidelines that, you know, basically regulate the activities within the profession. You know, so professional bodies that regulate the audit profession usually will set high standards of behavior. They'll set high standards of behavior. So there are certain expectations that people who are in the audit profession must exhibit or must show. You know, and these rules of conduct could also vary, could depend on different professional bodies. They determine, you know, these rules of conduct. But what you need to know is that the ICA Ghana has adopted the IESBA code, the ISBA code. And so the ICA will be following the ISBA code in terms of, you know, these standards and in terms of these principles and guidelines that regulate the audit profession. Very, very key. Very, very key. So let's talk about the fundamental principles of the ISBA code. The fundamental principles of the ISBA code. I use the acronym COPPI. COPPI, C-O-P-P-I. C-O-P-P-I. So let's flip this a little bit. We'll start with confidentiality. COPPI, C-O-P-P-I, in case you're writing. So let's flip this a little bit, right? Let's flip this a little bit. Let's start with confidentiality. On my slide, I have integrity, but let's start with confidentiality. You know, anyone who is a professional accountant should respect and should know that the information they are exposed to is confidential. And as such, any business relationships or any client relationships should be treated with utmost confidentiality. You should not disclose confidential client information, you know, when you haven't been given the permission to do so. So unless there's a legal right to disclose, you shouldn't disclose any confidential information, or unless there's a professional right to do so, you shouldn't also disclose confidential information. Or unless there's a duty to disclose, you shouldn't do that. So unless maybe a court is restraining you and telling you, you know, we need to have this information. In that case, it's a legal, it's within the legal framework and within the legal context. And so you have the right to disclose. But when it comes to confidentiality, the auditor must understand that it's important to be confidential with clients' information. That's extremely crucial, extremely crucial, extremely crucial. Okay, so that's the first C, COPPI, C-O-P-P-I. Let's go to O, objectivity. Objectivity. You know, the professional accountant must be objective. You know, it means that he must not be biased. You know, he must not be biased towards anybody. He must be objective in carrying out his duties or her duties. You know, and the professional accountants must not compromise their professional standards because of conflict of interest or undue influence. They should not, the professional accountant shouldn't be influenced by anyone. They should make their judgment on whatever they are working on objectively. So that's very, very crucial, right? Because if the accountant or the auditor is not objective, how can we rely on the information? You know, let's say an accountant is preparing a financial, or is auditing a financial statement, right? And they are not objective, you know, they are in bed with the client. How can you rely on such a financial statement? You can't. You can't. So you have CO. Let's move on to P. P is professional competence and due care. Professional competence and due care. You know, so the auditor must show professional knowledge, must maintain professional knowledge and skill at the level required to ensure that the client receives, you know, very, very good service. So the competence of the auditor must be intact. The competence of the auditor must be intact. This is really crucial. This is really crucial because once you understand this, you'll be able to, you know, develop and work on your skills as an auditor. So quite critical, right? Very, very important. Very, very important. Then the next P, so COP, the next P is professional behavior. So the accountant or the auditor must comply with relevant laws and regulations and should avoid any conduct that discredits the profession. You know, so an auditor can be taking bribe, an auditor can be stealing, an auditor shouldn't be corrupt. Anything that would dent the image of the profession, the auditor should stay away. That's professionalism, professional behavior. So please take note of that. So COPPI. The last one is I, which is integrity. So when we talk about integrity, we're simply talking about honesty and being straightforward. The auditor shouldn't be a crook. Should be a straightforward person, you know. Should be a straightforward person. A professional accountant shall be straightforward and honest in all professional and business relationships. So please remember these 5 fundamental principles. I thought I would have to share with you. COPPI, copy. So what I used to remember is auditors or professional accountants don't copy. They don't copy or they don't steal. They don't copy, basically, so that you can remember. COPPI. And this one is critical because they can easily ask a question on it. It's a core area of auditing. So they might easily ask a question around the fundamental principles of the ISBA code. So please take note of it. I'm stressing it because I just want you to be clear. You know, I just want you to be clear on it. Okay. So we can talk about independence. So when we say independence, what do you understand by independence? Does anyone have a clue? When we say independence, what do we mean by independence?
It means that the person cannot be influenced on certain issues.
Okay, that's very, very true. So we are talking about independence. We are talking about being able to act devoid of influence. So in order that a member's auditor's report, right, is of value, auditors must have independence of mind and independence in appearance. So these are the 2 forms of independence. Independence in mind and independence in appearance. So independence in mind alone is not enough. independence in appearance alone is not enough. They must have both. But what do these things mean? What do these things mean? So when we say independence in mind, it means that the auditor must be independent. When we say independence in appearance, it means that the auditor must be seen as independent. And I'll explain again. So when we say independence of mind, we are describing basically a mental framework of the auditor that permits the auditor to express their opinion or conclusion on the work without being affected by influences, external influences that will compromise their professionalism. So that's independence in mind. It's a state of mind. But independence of appearance is being seen as independent. So what does this mean? It means that auditors should avoid facts and circumstances that are so significant, that are so glaring, that an informed third party will likely conclude on them that they've compromised their ethical standards or their professional standards. So that's independence in appearance. It's the avoidance of facts and circumstances that are so significant that a reasonable and informed third party will be likely to conclude that a firm's or a member of the audit or assurance team's integrity has been compromised. So it might be confusing. So let's give an example. So for example, if you're an auditor and you own shares in the client you are auditing, this compromises your independence and appearance. Because a reasonably informed party will say, oh, then the auditor, will not be objective. The auditor will not, be unbiased when it comes to auditing the financial statement because he has shares. He has shares in the company. So I hope this difference is clear. I would like someone to volunteer to establish this difference, because it's very important. It's very, very important. So if someone can explain it in their own words, just to reiterate the point. Can someone explain this in their own words? Okay, Thomas, you can go. Thomas, do you have a question? Thomas.
Hello.
Yes. Do you have a question or?
Yes.
A question?
I'm trying to explain independence itself and appearing to be independence in appearance and independence in principle.
Okay. Please explain the difference.
So, if you say the auditor is independent in principle, it means that he's actually independent. So, in the conduct of his work, in his audit of a financial statement whatsoever, he's actually independent. So there is nothing that influences what he does. If we say the auditor should be independent in appearance, we are saying that nobody should think that the auditor is influenced in any way. So there shouldn't be any activity or any action of the auditor that will make somebody even think for a moment or even suspect that the auditor is influenced by something else.
Okay, that's a very, very good differentiation. That's a very, very good differentiation. So when we say independence of mind, it's about the auditor himself. When we say independence of appearance, it's about a third party. How the third party views the auditor or informed third party views the auditor. It's important. It's important. So thank you, Thomas. That was a very, very good one. The reason why I'm taking pains to go through this is it's extremely important. It's extremely important. The whole foundation of audit is independence. Okay, then let's talk about some independence matters So auditors must always be fully aware of situations that may damage their independence. The auditor must be aware of that. And if there are any threats to their independence, they must quickly put up safeguards, what we call safeguards, to ensure that those threats are mitigated. And so how does the code approach this whole independence issue? The code, what the code does is it does not offer specific rules. So you do X, Y, Z, but it only guides. And with guidance, guidance gives room for application. So the member, the auditor is able to apply how the guidance should, how the guidance should basically be implemented. So that's something you need to keep in mind. So let's talk about some threats. The threats to independence, things that undermine independence. So you have I usually use the acronym if, as, and as. Intimidation threats, familiarity threats, advocacy threats, self-interest, and self-review threats. If and as. So if we are going by that, let's just start with self-interest, self-review threats. So what is a self-interest threat? It's basically when the accountant or the auditor has a financial interest in a matter, So for a typical example is when they own shares in the client's company. If they own shares, it means that they have a financial interest in the company. Then self-review threat takes place when the auditor or the accountant is required or made to review a previous judgment he has offered on some information, So basically, it's reviewing your own work as an auditor. It doesn't make sense. It's like let's say you write your audit exam, right? After you write the audit exam, then you sit down and the examiner says you take your paper and mark it again. That's self-review. It defeats the whole purpose of review. It defeats the entire purpose of review. So that's a threat to independence. You have advocacy threats. The advocacy threats. When you say advocacy, English word, advocate. So this occurs when the accountant is in a position where he's expected to justify the position of the client. Basically, he's acting as an advocate for the client's position. So the auditor or the accountant is not in the business of advocating for the client. So a typical example will be defending the client in court on matters that are related to the financial statements. Just think about this for a moment. If you are an auditor, right, and you audited the financial statements, and like there's an issue with it, it's in court, and they call you to speak on it, won't you defend what you audited? You will. So the auditor shouldn't be in the business of advocating. If you're advocating, it's a threat. It's a threat to independence. Then you have intimidation threats. This is where the client issues threats. It could be subtle or open against the auditor. So a typical example is, if you don't kowtow to us, if you don't toe our line, we'll take the work away from you. We'll take the business away from you. You won't get money. That's intimidation. Intimidation is a threat to independence. They also have familiarity. What's familiarity? When we say familiarity, This occurs when the accountant has a long association with the client or a long relationship. And when you have a long relationship with someone, you develop a soft spot for the person, right? So when the auditor is engaged with the client for very long, and that's why it's recommended that, audit firms change clients because of this familiarity threat. Okay. I hope it's clear. If and as, or as if, like they say in Ghana, why not as if. You can also use that. Why not as if. So advocacy threats, self-interest and self-review threats, intimidation threats, and familiarity threats. I hope it's clear. Okay. So the code, right, gives guidance on threats that accountants face. There are a lot of threats. The threats you mentioned, we categorize them nicely. But what we need to know here is that if the financial interest, a financial interest in a client might constitute a self-interest threat, a self-interest threat, which we already talked about, actually, So what does the guidance have to say about this? The guidance recommends that a member of the assurance team or an immediate family member of that team shall not hold a direct financial interest or an indirect material interest in a client. And if they have anything like that, they should dispose it of, or the team member removed from the engagement. Very, very important. Where your treasure is, your heart is also there. So if an auditor has a financial interest in a client, they will not be objective, they will not be independent. So the guidance is saying that you either have to dispose of your investment in that client or just remove them from the engagement. Extremely key. Then you have loans and guarantees. A loan from a client, which is a bank or similar institution, made on normal commercial terms, will not constitute a threat to independence. So if there's a loan within normal commercial terms, normal business context, it does not constitute a threat to independence. But if it's outside the context of a normal commercial term or normal business context, then it constitutes a self-interest threat. I hope it's clear. If the loan is made within the context of a normal commercial transaction, it will not constitute a threat to independence. But if it's made outside, then it does. Okay. So we are talking more about the threat accountants face and the guidance, right? So for example, if we take close business relationships, what kind of threats do you think close business relationships might produce? What kind of threats?
Familiarity threats.
Fantastic. Familiarity threats. Because you are associated with, clients. You're associated with a client, maybe for long. So close business relationships with assurance clients represent a self-interest threat, or could create a self-interest threat, familiarity threat, or even intimidation threat. Could also create all those kinds of threats. So that is something the auditor needs to watch. Very, very important. Very, very important. Then let's move on to family and personal relationships. And when we talk about family and personal relationships, it's quite similar to business relationships. It's all about relationships, right? So family and personal relationship between assurance staff and clients might cause familiarity, intimidation threats, self-interest threats, right? So for example, let's say you're an auditor, let me use Caleb and Kingsley. Caleb is an auditor. He works with PwC. And then Caleb's brother works in Vodafone. PwC audits Vodafone. So Caleb's brother works with Vodafone. Caleb's brother, who is Kingsley, works with Vodafone. There might be some familiarity, self-interest threats right there. So that's very, very something the auditor has to watch for. That's something the auditor has to watch for. It's not possible to, sometimes it's not practical to, in an audit firm, there are so many people. So it might not be practical to take everyone and be looking for their brothers and sisters, whether they work here, but you need to go to that extent and assess the closeness of the relationship and how it can have an adverse impact on independence and objectivity. That's very, very key. Very, very key. Very, very key. So when an immediate family member, we are talking about how deep the threat is. When an immediate family member is, let's say, a director or an employee, and has significant power over the engagement, over the audits, then, the threat here becomes very, very huge. And so the audit firm will go to the extent of removing the individual from the assurance team. He has to remove them. He has to remove him or her, because there's an immediate family member, one, and two, this employee has significant influence over the engagement. Any questions so far? Are there any questions so far? Okay. It looks like there are no questions. We are still on the threats and the guidance. We are talking about the different situations, Employment with assurance clients. What do you think this would be? What do you think will happen when let's say, an employee of the client has been recruited by the assurance firm? What do you think might happen when an employee at the client's end has been recruited by the assurance firm? What are some threats that this might pose?
I think this will pose a self-review threat.
Okay.
Yeah,
Why will it impose? Okay.
Well, in the sense that when there is an audit, the person might have the opportunity to audit the work that he has done in his previous employment in the audit client.
Okay, so what you're saying When you say the person, which person?
The the individual who was employed, who recently, I don't know how to put it, but the person who was employed in the audit client and is now in employment with the audit firm.
Okay.
Yes.
Okay. So let's say.
So yeah.
Okay. So let's say.
So when, okay, I'm listening.
Let's use like practical example. So use
Okay.
two companies. Use
Okay.
PwCMA or whichever, KPMG and another company, and let's see how that works.
Okay. Let's say an individual used to work with Goyle, Goyle, and is now in employment with PwC. PwC now has a contract to audit the um, books of Goyle as a company or as its audit client. So the person having worked with Goyle in the past might have the opportunity to probably correct some of the mistakes that was made when he was with Goyle.
I see what you mean. So
that is
you are saying that, let's
yeah,
say this person was in Go, he probably worked in the finance department, was
department,
involved
exactly.
in preparation of the financial statements. Then he moves to PwC, That's what you're
Yeah.
saying, right?
Yes, please.
Yeah. Okay, makes perfect sense. That's a very, very intelligent point. That's a very, very good one. So yeah, it can happen that way where, okay, Nimatu, that's a very, very good one. Thank you, Seth. Nimatu, you've raised your hand. Please go on. Nimatu. Nimatu.
Hello, sir.
Yes.
Hello.
Yes, I can
I
hear
said
you.
I think it can also cause familiarity threat.
That's true. Please
Because,
explain. Please tell us why.
Because let me just use the same company, like KPMG and then Goyle. Okay, because the client, the person employed was currently working with Goyle, the person will know a lot of people under Goyle. So auditing the books.
Oh, please go on.
Auditing the books can like influence some kind of decision or something like that. I don't know.
Yeah, that's very, very true too. That's a very good point. Somebody has raised their hand. Is it Ruthike?
Yeah, Isaac here.
Okay, Isaac. Okay.
Yes. Please,
but who is Ruthike? Is that your nickname?
Okay, Ruth is my wife. And
oh, okay. Oh, okay. I see.
Yeah.
I see. Okay. Ruth and Isaac.
Yeah.
Oh, okay.
Yes.
Okay. Nice one. Okay, go
yes.
ahead.
So, just a question on this, but more on the your previous slide, okay, where you made instances on family and personal relationships. I've just been thinking, how do we deal with such a situation where maybe the individual involved does not disclose or keeps some of this information or some of these relationships, keeps it close to himself and does not reveal even to the entire team. For instance, I have, a cousin, in this company, knowing very well he's my cousin, but I mean, I've not disclosed it, and he's my cousin. The two of us, we know ourselves, but the two institutions are not aware of this, but we've kept, this information to ourselves. I've just been thinking the best way to go around this when these issues come up, because we live in a small world. Because you can go somewhere and you realize that, you have a classmate there, and then It could be anything. So I'm just been thinking, what's the best way around some of these issues?
So what you're saying is that what happens if you don't disclose, right?
Yes.
Yeah. What happens can anyone help before I even chip in? Can anyone help? What happens if someone doesn't disclose their family relationships? What happens? Is anyone in audit? I know there's someone at EY here. But is anyone in audit? Will anyone take a stab at this? What happens if you don't disclose? Oh, I'm just looking for guesses, so I'm not looking for right answers. Any clue, please?
Sir, please let me guess.
Yeah, just guess. Guess.
All right. So probably the person may not disclose if the person thinks he can still be independent despite the fact that they have a family relation, and it will not be really that a threat. However, if the person does not disclose and it affects the financial and it affects the report, or yes, it affects the report, then if it's later known, I think it will then go back to then go back to qualify that probably previously unqualified report.
Okay.